right, good afternoon and welcome to Life Skills 101, the Basics of Home Buying. I am Jean Service. I'm one of the event coordinators here at the General Alumni Association at UNC. I'd like to welcome all of you today to this event. Special shout out and thank you to the GAA members who help make events like this possible. Today, Norman Block, three-time UNC graduate, will be presenting a lot of information to you, and hopefully you've all seen and downloaded the 3 documents in the recent confirmation email. We will resend those in our post-event email, which will go out by the end of the day on Friday at the latest. Along with that, we will have a recording of this event and some additional notes, verbatim notes, as well as these slideshows that Norman will be sharing. So don't feel like you have to frantically write everything down today. You can just sit and listen to what he's saying. If you have questions, please enter those in the chat and we will read those out throughout today's presentation. And at the end, we will have some time for additional questions. I would recommend that you remain on mute and that you set your screen up for speaker view, and Norman will be sharing his slideshow. So welcome, Norman.
Hey, thank you, Jean. I'm excited about being with you today. And I know that we have only an hour to spend together. So I want to reiterate what Jean said. After the course today, you're going to get a set of all the slides that you're going to see. And in addition, you're going to get almost verbatim transcript of everything that we talk about. So you don't need to have to struggle with taking notes as we go forward. There's a lot of information to share, and we want to use time wisely as we can. But I'm really happy to be with you, and hopefully we can share some information that'll be helpful to you. You should have in front of you a sort of timeline looking sheet that starts the process of buying a home with something called qualifying. And then the next step after you know what your financing is going to be like is to do a home search. We're going to talk about making an offer and the negotiations that go into that, forming a contract. Then we're going to talk about doing your due diligence, because this is a fairly complicated transaction. In fact, buying a home is a multi-step process for most folks. It's the largest purchase that they'll ever make, and it's accompanied by the largest debt that most families will ever have. So you want to be very careful as we go through this, and in doing your due diligence, if possible, to negotiate repairs that the seller should make. We'll talk about that. Reinspection, talk about closing and settlement. And towards the end of our hour, I want to give you a pretty good checklist of things to know about a closing that you need to get ready in advance and be thinking about. And then the transfer of the title. So it's worth studying the process. You need to know what the steps are so that you can make a plan of how to approach this process. First thing, before we even get on that timeline, so to speak, is the rent versus buy question. And let's just pose a hypothetical for ourselves. Let's say that the monthly payments all in to purchase and own a 3-bedroom, 2-bath townhome comes to $1,813 a month. That's an example we'll use. We're going to talk about a $300,000 townhome that maybe you buy with 5% down. If we do the numbers, it comes out to be about $1,813 a month for ownership. Well, if we looked and saw in our home market that we could rent a townhome style apartment with 3 bedrooms and 2 baths, same square footage, for about $1,450 a month, the uninformed person might say, well, gosh, I could save $363 a month by renting rather than buying. In 3 years, that's over $13,000. I think coming out of school and getting started, I'd be a lot smarter to do that to help me have a bigger down payment when it comes time to buy. Well, is it really that simple? is renting really less expensive than owning? I don't think so. We need to dig into what that cost of monthly home ownership is. What does it really cost us to keep that roof over our head? Now, if you'll get out the sheet that hopefully you downloaded before class that says the real cost of home ownership across the top, there's right up there on the screen for you, you'll see that we're going to work with a hypothetical example of purchasing a townhome or a home for $300,000. We're going to assume we only have 5% to put down. So that's going to leave us with a loan amount of $285,000. And we're going to assume that we can get that loan at 3.5% for a 30-year loan. Listed below are all the things that go into the monthly components that go into making up what our total monthly payment is. And you can see where I got the 1813. We're going to go through these as part of our learning process. The first three items, the 1280, the 225, and the 70, that's three things, all of which get paid to the mortgage lender. First is principal and interest. Second is tax accrual. And third is insurance. Let's talk about that a little bit more. We call this PITI. You'll hear that term, lenders use it all the time. What's the PITI payment? It stands for principal, interest, taxes, and insurance. The P, the principal, is the amount of money that's being used to reduce the loan. Mortgages are what's called self-amortizing. As you make the payments, it gradually pays itself off, and the principal amount of any payment is what's being used to pay down that loan, to repay the loan. I, the interest, is the ongoing cost of borrowing the money. It's basically the rent on those dollars for that month that you have that mortgage outstanding. T stands for taxes. And some folks are surprised that in the typical mortgage, every month, the bank or the mortgage company is going to collect 1/12 of the property taxes, and they're going to put that into an escrow account so that when the tax bill comes out in late summer, they can pay the taxes on the property, not you. The tax bill will be in your name, but the bank's going to pay those taxes. A lot of times folks say, well, why? Why would they do that? And the answer is pretty simple. Remember, we said we're only going to have 5% down. The bank's going to have 95% of the money in this deal. They have a lot more money in this deal than we do. They want to make absolutely sure those taxes get paid. And so they're going to collect 1/12 each month and then pay the tax bill for you when it comes due. That's called escrow. They're going to put that money every month in escrow and then pay that bill when it comes due. And the same is true of the second I, which stands for insurance. Homeowners insurance is really important also. The bank cares about it for the same reason. They've got more money in this deal than you do. If there were to be a hazard or a fire or a flood or a property damage of some sort, they would be in jeopardy. And so with insurance, if an insurance policy lapses by even 1 day, there's no insurance. They want to make absolutely sure that insurance stays in force. So again, they're going to collect 1/12 each month, escrow it, and pay that for you. So those first three, lines 1, 2, and 3, you're going to pay to the bank or mortgage company, and that's called the PITI payment, principal, interest, taxes, and insurance. Line number 4 shows $160 for condo or association dues. Almost every residential community today has some type of homeowners association. If it's a townhome or a condominium, the dues are going to be higher because in those formats of ownership, the condominium itself or the townhome community takes care of the grounds and probably some parts of the structure. Some townhomes take care of the roofs, for example. The last item, number 5, is called mortgage insurance. And this is a policy of insurance that the bank makes you purchase for them if you're borrowing more than 80% on the mortgage. It's been the standard for as long as I can remember that banks and mortgage lenders are very comfortable loaning 80% of value. The standard home mortgage is 80% from the lender, 20% down payment. Now, you can borrow 90%, 95%, maybe as high as 97%. But as you borrow more money, you have less money in the deal. The lender is much more at risk. If you've got 20% of 300,000, that would be $60,000 invested. You're not going to walk away from that. But if you only had $10,000 and things went terrible in your life, you might walk away. So what's happened is that the industry has evolved in a way that if the loan amount is more than 80%, they're going to typically ask you to purchase for them a policy of insurance called mortgage insurance that insures that top part of the mortgage, that part that's above 80%. They're going to make you pay for it, even though it's for their benefit. And we're going to talk a little bit more about this PMI, private mortgage insurance, as we go forward. But just be aware that when you borrow more than 80%, the typical requirement of a lender is that you have what's called PMI, private mortgage insurance. If you have a government-backed loan, like an FHA loan, there's still mortgage insurance involved, but it's not private, it's government mortgage insurance. So that's why you'll hear the term PMI a lot. Okay, back on our worksheet, you'll see that it does in fact cost $1,813 a month to keep this roof over our head. In some cases, a bank will actually make you pay in the homeowners association dues to them. More typically, you will pay the homeowners association dues directly to the HOA, but you would pay to the lender everything else. They're going to collect the principal and interest, the tax accrual, the property insurance accrual, and mortgage insurance if it's applicable. So just keep in mind that you may and probably will pay the HOA dues separately, but there are some lenders that require it all to be paid in. My point here really is that the cost of keeping a roof over our heads, the monthly outflow, if you want to call it that, is $1,813. Now, that would look like it's more expensive than renting, but that's not the end of the story. There are 4 other factors that come into play. The first factor we talked about is that monthly outflow, the monthly cost of home ownership. The second factor has to do with tax deductions. The federal government and most state governments want to incentivize home ownership. It's good for society for people to own their own homes. And so they've made certain things tax deductible. We'll talk about that. The third factor is equity buildup. Remember when we were talking about principal, interest, taxes, insurance, we talked about P being that part of each monthly payment that goes to pay the loan down. Well, as you pay that loan down, you have more ownership, you have more equity. Those are dollars you will see again. We need to know how they come into play. And then the fourth factor has to do with increase in value due to appreciation. Property values going up. As appreciation takes place, the bank doesn't get that, you get that. We want to see how that impacts. So we're going to look at all 4 factors to look at the real bottom line cost of home ownership. Let's start out by talking about taxes. The government has set up incentives, as I said, to encourage home ownership. They do it really with your personal residence in 2 different ways. One is through deductions. They allow you to deduct certain expenses from your taxable income. Deductions reduce the amount of income that you pay taxes on. If I've been renting for the last 5 years and all of a sudden I become a homeowner, I'm going to have some deductions I didn't have before. So I'll be paying income tax on a smaller amount of money. There's also a provision where if we meet certain requirements, the gains in value of the property over time can escape taxation altogether. This is with your personal residence. We want to talk about that. Again, you'll want to save these notes and save these slides so that you can go back and review those when the time comes. In an owner-occupied single-family home, townhome, condo, doesn't matter format, the first thing that the tax rules do for us is they allow us to deduct mortgage interest. The interest paid on the mortgage becomes a deductible item. Up until 1980, that was unlimited. You could have $1 million worth of interest paid in a year and you can write that off. That's why a lot of really wealthy people own multiple properties. When Trump passed the major tax reform bill that went into effect, I believe in 81, they capped that. Probably won't be a problem for most of us, but what it says is you can deduct the mortgage interest on up to $750,000 in mortgage debt. So if you're one of those folks that has a $2 million home and you have $1.5 million mortgage, you're not going to be able to deduct all of the interest any longer. But for most of us, our mortgages will be under $750,000, so our mortgage interest will be deductible. The second thing that's tax deductible is the property taxes that we would pay to a county or local or even maybe a state government. And that same Tax Reform Act that was passed also put a cap on that. Right now, property taxes and taxes paid to the state are capped at $10,000 in any given year. So we'll have to keep those in mind as we go forward. There are some limitations. The caveat that I would throw in for you here is that these deductions apply when you itemize on your tax return. If you take the standard deduction, the assumption is it's all built in, and so you would not get these separate deductions. But what I've found in my practice is most people, once you own your own home, they're going to end up itemizing because it's going to turn out to be better for them. But you and your tax preparer just need to be in that discussion, and you need to be aware that interest on the mortgage is deductible, property taxes are deductible within these limits, but you have to itemize in order to do that. So let's take a review of where we are so far. We've done the numbers on our worksheet down to where we've looked at the monthly outflow, and it's $1,813 a month. But we've also said that's not the end of the story. We get to deduct the interest. What you'll see on the screen right now is something called an amortization schedule. Every mortgage loan has a fixed printed amortization schedule. It's not revolving credit. It's not like a credit card where the interest is refigured every month. In a mortgage, the payments are fixed and remain the same. You'll see in the column labeled payment, the monthly payment on this loan is $1,279.78 every month. That never changes. The next column lists the interest that it's required to pay the interest for the month on the beginning loan balance. And what's left over goes to principal. So you can see, like on month number one, we started with a $285,000 mortgage, $448.53 went towards principal. So at the end of that month, we only owe $284,551, which is the original loan amount less the principal payment. Well, amortization schedules can sum up for any given period of time how much interest. You'll see highlighted in yellow that in the first 12 months, we're going to have $9,888 in mortgage interest. Since our whole worksheet is based on the monthly cost, we have to divide that by 12 to get a monthly amount of interest of $842. And I've highlighted that and I've entered that on line 7. Okay, there's our interest deduction.
Norman, 824.
Yes, 824, sorry. I can't chew gum and read at the same time. The second thing that's deductible is taxes. Well, we know what the monthly tax accrual is. We figured that up above. That's on line 2. And so we can plug in that 225. It's coming right from line 2 where we figured up the monthly taxes. And that gives us total deductions of $1,049. I know some of you are probably sitting back saying, man, I thought there wasn't going to be any math in this. Well, I'm going to do the math for you, but I want you to see how the numbers flow so you can see how these 4 different factors of home ownership fit together. What I'm saying here in the second factor of tax deductions is that every month, yes, we're writing out checks for $1,813, but $1,049 of that is tax deductible. Well, what are those deductions worth to us? Well, that depends. Depends on what tax bracket you're in. Let's say that you're in a 24% federal bracket and a 5% state bracket. So a total bracket of 29%. What those deductions are worth is the taxes that you're going to save that you would otherwise pay to the government if you didn't have those deductions. Well, 29% of $1,049 is $304. Now, I know it's hard to get your hands around this until you get used to some of this language and some of these buzzwords. But what we're saying is because of $1,049 in deductions, we're going to save $304 in taxes that we would otherwise have paid to the government. So I could make the argument with you that the real cost of home ownership is not $1,813, it's actually $1,509, because that $304 is money that's going to stay in your pocket that would otherwise go to the government. If you're a renter today, someone is in fact deducting the interest and the property taxes where you live. It's just not you, it's the landlord. The landlord's getting the benefit of it, even though the payments are being made with your rent money. So that's the second factor, tax deductions. But again, that's not the end of the story either. The third factor of home ownership is the equity that we build up by paying down the loan. We said before that each month when you make a payment, that house is a little more yours. The loan is paid down, you have more equity. I like to think about it with a car payment, sort of easier to grasp. Every time I make a car payment, that car's a little more mine, and in the end, I own 100% of it. So as I make those principal payments, I'm going to see those dollars again also. I'm going to see them at the time I refinance or at the time I sell the property. Well, how do we figure out what the monthly principal pay down is? Well, we know from above that each payment has a component of interest and a component of principal. It's real interesting to look at this curve on this graph. That curved line represents the payback of principal in a 30-year mortgage. One of the things I want to point out to you is that is not a straight line. This mortgage instrument is created by bankers, it's created for bankers, and what you'll see is in the early years, the payments are almost all interest, and in the later years, you gradually get into a period of time where you're knocking down some serious principal, but every payment has some principal involved. Not to be discouraging, but to show you the impact of this line not being straight, you can pay for 20 years on a 30-year mortgage and still owe 50% of what you borrowed. Let me say that again. Because of the way this creature was created, this mortgage was invented, the way mortgages work with that curved line, you can pay for 20 years and still owe half of what you borrowed. But every payment does have some interest and some principal, okay? Well, we know that the P&I payment, principal and interest, is $1,280. That's up on line number 1. That's calculated. And we figured out that the interest was $824. We just figured that on line 7 above. So if $1,280 is principal and interest, and we deduct the interest, the rest has to be the principal payment. So every month in this first year, on average, we're going to pay $456 in principal, pay the loan down by that amount. Those are dollars we're going to see again also. And so I think we could make the case that the real cost of home ownership is not $1,813, it's $1,053 a month. Things are looking better. But that's not the end of the story either, because there's a fourth factor. The fourth factor is equity that's built up by the real estate appreciating in value. There are ups and downs in the real estate cycle, but over any 10-year period of time, even including the Great Recession of 2008 to 2012, real estate has increased in value over any 10-year period you want to look at. The last couple of years, it's been red hot, sky high, big time appreciation. Here in North Carolina in the Triangle, we've seen anywhere from 9 to 15% per year for the last 2 years. Well, I want to be very conservative. I'm going to only use 3%. You can play around with some other numbers, but let's say this $300,000 home we bought appreciates in value 3% in the next year. That would be $9,000. That would mean if we came back a year from now, that same property would sell for $309. We're seeing that monthly right now in some markets, but again, I want to be conservative. If the appreciation in value is $9,000 for the year, we've got to get it on a monthly basis because we're using a monthly worksheet. So we divide the $9,000 by 12, and that gives us $750 a month from appreciation in value. Again, those are dollars that accrue to us, not to the lender. It's like a forced savings plan. If you live in a property and gradually pay down the mortgage while the market increases the value, you're building equity in two ways. So I think we could make the argument that the real cost of home ownership is not the $1,813 that we started with. It's really only about $303. And I had somebody say the other day, so I could rent out a room for $303 and it wouldn't cost me anything to live there. Well, it's not quite as simple as that. I want to be straight and be sure I'm not confusing you. You have to write checks for $1,813 a month, every month, keep that roof over your head. But when you factor in tax deductions, equity buildup through principal payments, and equity buildup through appreciation, yes, your cost, real cost is only $303. So if we look at the cost of ownership after all four factors are considered and compare that with rent, well, you'll get my point. There's lots in favor of home ownership, and it's not true that renting is the better way to go. Rent dollars are dollars you'll never see again. You pay them out and they're gone. There's no benefit to you. You'll never see that money again. When you make payments on a home, all four of these factors come into play to help create wealth for you, to help boost your net worth. Now, all that said, you do have to qualify for a loan. You do have to have a down payment. You do have to have some type of steady employment in order to get a home mortgage. So let's be sure we know that there are some requirements, but if you can, ownership's going to be more favorable to you than renting. All right, I mentioned to you in the beginning that deductions were one of the ways the government incentivizes home ownership, and another way is escaping tax altogether. There's a provision in the tax law that says on the sale of a primary residence, that means the home you live in, if you lived in it for 2 of the preceding 5 years, a married couple can exclude up to $500,000 in gain and never pay taxes on it. A single person can exclude up to $250,000 in gain and never pay taxes on it. Say what? Yep. What they're saying is that appreciation in value, that equity buildup, it's going to be yours without taxation if these requirements are met. It has to have been your primary residence for 2 of the last 5 years, not the last 2 years before you sell it. It could be a situation where I moved out, rented my house for 2 years, came back and sold it. I can still sell it as my personal residence and totally exclude from taxation a gain of $500,000 if I'm a married couple, or 250 if I'm a single person. And you can use this strategy every 2 years. What that means for my builder friends is that they're moving all the time. The wives of builders are frustrated because their boxes are never unpacked. A builder will build a house, live in it for 2 years, sell it for a lot more than it cost him to build it, take that profit, put it in his pocket, pay no taxes on it, repeat the same process. And there are people right now in this red hot market that are taking advantage of the great appreciation and value we're seeing today. And they're selling their primary homes because they know they've got that gain built in there and they can escape taxation on it. The problem for them, though, is then they have to find someplace else to live. You got to replace it. Are there times when maybe you should rent and not buy? Well, yes. Let's talk about that. If you're not sure where you want to live, then I don't think you should make a purchase. Like people moving into the Research Triangle where we are, lots of folks come in here because this is where the jobs are. Maybe one spouse has a job at NC State, but they don't know where the other spouse is going to be working. It might be Chapel Hill, it might be Clayton, it might be Wake Forest, it might be Apex. And so if you're not sure where you're going to live, not settled yet, you might rent for a year. We see a lot of people say, I'm going to rent for a year before I buy, because they want to figure out where in the market they want to be. I talked to a student just the other day that's moving to Austin, Texas. Same situation. There's just way too many areas. He doesn't even know what part of the community he wants to live in. So he's going to rent for a year until he decides. Another reason why you might rent rather than buy is if you're not sure you're going to be in this particular location for more than a year or two. It takes money to originate a mortgage. There are closing costs when you go into a purchase, and there are closing costs when you go out. So if you're only going to be in a location for a short amount of time, it may not appreciate in value enough to cover all those costs. You might be smarter to rent if you're there for a short period of time. I talk to people here in Raleigh that I hear young people say all the time, I love my job with Red Hat, but I don't know if I'll be here in 2 years. I don't want a mortgage hanging around my neck when it's time for me to move. And so that might be a reason you would rent rather than buy. Another reason is if you don't have a down payment. You know, this isn't the easy credit years of 2000 to 2008 where you didn't really have to have a very big down payment. You didn't have to have good credit. There were all these so-called no-doc loans. That's how we got to the bust of 2008. That's not true today. Lenders are being very careful to underwrite loans, to verify people's financial status. You do have to have a down payment. And some folks just haven't been good savers. They don't have any down payment, so they end up renting. Another possibility is if you don't have stable income, like you've just gotten out of school and you're not sure exactly whether this job is going to be a permanent job and it may not be a corporate situation. The bank's probably going to say you've got to have a track record of stable income before we can make a mortgage for you. And then, of course, if you have bad credit, you're not going to be able to get a mortgage, so you're not going to be able to buy in that situation either. It's something we need to be talking to our children and our grandchildren and young people about is don't walk away and not pay that credit card bill or not pay that cell phone bill. That bad credit will come back to haunt you. Somebody asked in a question, what was the credit score that would enable you to buy a home? Most lenders will tell you that if you've got 680 or above, they can work with you. Now, as you get better and better on your credit score, you can get better terms. But if you've got a 680 or better, you'll probably be able to get a mortgage without any trouble. Okay, well, let's talk a little bit more about financing. someone asked, how's a lender going to look at me? When I come in to seek a home mortgage, what are they going to want to know? Well, let's you and I put on the lender's shoes. Let's say you're the bank and I want to borrow from you. In fact, let's make it real. Let's say that I want to come and borrow $300,000 from you. What do you need to know about me? Well, I can tell you the first question that I would want to know is, can I trust you? Will you repay me? You and I would probably call that trustworthiness. Bankers call it creditworthiness. Will you repay me? And then the second question is, well, you seem like an honest person, and I know you would want to do the right thing, but do you have the ability to repay me? Even if you are honest and want to, can you repay me? You and I might call that the ability to pay. Lenders call that financial capacity. You know, there's lots of jargon in real estate. There's lots of jargon in banking, and it can be intimidating, these big words, but they're just words. And so it might help to create a little cheat sheet of what some of these words mean. Creditworthiness, that's just trustworthiness. How have you handled credit in the past? Financial capacity is your ability to repay. When they investigate or underwrite you and the loan to look to see how you've handled credit in the past, they're going to pull a credit report, see if you have any delinquencies reported, see what your credit score is. It's basically them looking to see how you've handled credit in the past. That's their indicator of trustworthiness. When it comes to investigating your ability to pay, that's where qualifying comes in. And if you'll remember on our timeline of the process, qualifying was actually the first step, because you need to know how a bank is going to view you, how much money you can borrow, so that you can determine how much house you can afford. As a realtor, the most unkind thing I could do is take somebody out, have them fall in love with a property that they absolutely can't afford and have no chance of buying. We need to start with the qualifying process of knowing how much mortgage we can get. Banks use two ratios in doing the qualifying analysis. They're also going to need and want to verify your employment. If you have earning assets like a portfolio of stocks or an inheritance, they're going to want to verify all that. And so what kind of documents will they ask you for? To document your personal income, they're going to ask to see not only your income statement, what you say your income is, but they're going to want to see your tax returns. They're going to want to see at least 2 years of tax.
I've got our directors meeting at 3 o'clock at REPB. So,
in order to verify and to study your assets, they're going to ask for your balance sheet, and they're going to want to see your actual bank statements and investment statements. They don't take anything for granted. It's all underwritten. It's all investigated. So as you begin thinking about buying a home, just know you're going to have to pull that paperwork together. And then they use two ratios to guide them, and you can use these for yourself to determine how much home you can afford. The first ratio, sometimes called the front ratio, compares your housing costs, that monthly cost to keep the roof over your head, to what your gross income is. And when we say gross income, gross means before taxes. And what the standard out there is that it should be a third, no more than a third of your gross monthly income. Let me say that another way. The bank is going to come to the table thinking that whatever your gross income is on a monthly basis before taxes, you really shouldn't have a house payment that takes up more than a third of that. Where does that come from? Well, they know and we know that when you look at federal, state, sales taxes, all things added up together, the average person is going to pay a third of everything they make in taxes. If you spend a third of what you make on housing, that only leaves a third for everything else, including savings and debt reduction. That's where that 33 1/3 comes from. The second ratio is similar, but a little different. The second ratio is sometimes called the back ratio. It compares all monthly debt to gross income. In other words, it looks not only at your house payment, but at your car payment and other things. And they say, we don't want to see all your payments added up together be more than 45% of your gross monthly income. That would be car payments, you have furniture payments, credit card payments, student loans come into play, any other installment debt that you might have. I will say one thing about student loans. I've learned that there are some lenders that don't count your student loans against you. They don't count it in that 45%. So that's a question you want to make note of and ask the lenders as you talk to lenders, and you should certainly shop for mortgages with more than one lender. You know, are my student loans going to count against me? And it may or may not be a problem depending on how tight you are in these qualifying ratios. Another thing to keep in the back of your mind, which is sort of a good thing to know, is that if you've got a car that's almost paid for or a loan that's almost paid off, if there are 3 or fewer payments left, they won't count that against you. And the logic there is it's going to take a month to process your loan. It's going to take some time for you to do your due diligence and close. And you don't have a mortgage payment the very first month that you originate the loan. So if it's 3 or less, it's not going to come into play and they won't count it against you. But basically, they're taking all the income. If it's a married couple, they're going to count both incomes. They're going to look at the recurring debts of both spouses, and they're going to look at the credit score of both. And they're going to determine how much loan they're willing to make to you. Now, I gave you some pretty definite numbers of 33 1/3 for the front ratio and 45% for the back ratio. That's one of those things that as your credit score is higher, as your job is more secure, a bigger, more dependable income, they'll bend on that front ratio some. The back ratio, not much. In any case, they're not going to let you have all debt payments exceed 50%. And almost every lender I know stops at 45%. But the key thing here, and the reason I'm saying do this early on, get with a lender, get qualified, even if that's not the lender you choose to go with in the end. You need to know how much loan you can qualify for, because if you know how much loan you can qualify for and you know the down payment that you have, you can determine the maximum price range. And you need to do that before you start your home search. Okay, so that's qualifying. Before we go out looking at properties, we need to know how much loan we're qualified for and what our down payment is. And we need to know that we have the money for that down payment and for closing costs. And the lender will help estimate what your closing costs would be for the loan program that you're talking to them about. Well, where are we in our steps? We talked about qualifying. That involves the buyer and the lender and maybe a mortgage broker. You know, there is a difference. A direct lender, like someone that works with Wells Fargo, they can only show you that bank's product. Like State Farm's only going to show you State Farm insurance. But mortgage brokers, like insurance brokers, can shop across lots of different sources. And so as you compare rates and talk about loans with folks, yeah, talk to your own lender, your own bank that you have a relationship with, but talk to a mortgage broker too. Now, as we talk about beginning the home search, I want to talk to you about having a professional assist you. Sometimes buyers are reluctant to engage a realtor to help them purchase a home or look for a home. And there's this mistaken thought that, well, if I don't have a realtor, I'll be able to negotiate the price down lower. That's not really true. It really doesn't cost you anything to have a real estate professional assist you. The sellers pay the commission, and they're not going to be able to lower the price if you don't have a realtor, because that listing is already listed with the listing broker. That commission has to be paid whether you have a buyer's agent or not. So since it doesn't cost you anything to have a professional standing by your side, I would definitely want to engage the services of a professional as my buyer's agent, representing only me, because I'm going to need that local knowledge. Okay. Well, we're now on to our home search. I want to say a couple of quick things. Don't just rely on Zillow. I know that's the most popular home search site out there, but it's not the most accurate. They advertise a lot. They got some cool features, so people go there. But actually, Realtor.com, REALTOR, has the most accurate information. It's tied into the real estate multiple listing service and will have the most up-to-date information, most accurate information. So don't just rely on Zillow. And then we were talking about using a professional. You know, there are people that are real estate agents that aren't actually realtors, members of the National Association of Realtors. I'll just say a positive word for them because they have a code of ethics. You know, they can be disciplined if they breach that code of ethics. They're going to have the best information and they have experience. Wherever you're going with your job or wherever you live now, when you come to the process of buying a home, you need good local information. All real estate is local. And it's very important that you have someone that's knowledgeable and experienced in that local market. One of the things that I would do early on is sit down with my realtor and make up a wish list of the things I want in a new home. We already know the maximum price we can consider. Let's talk about features. Let's make a list of things we have to have, and then another list of things we'd like to have. And what your realtor can do is can set you up in their multiple listing system as a prospect. And what that does is that every time a property is listed that meets your criteria, you'll immediately get an email and they'll immediately get an email, which will enable you to act fast. So I really encourage you to work with a real estate professional and have them set you up as a prospect to get that automated notice of new listings.
Norman, I just wanted to do a quick time check. It's 1:47.
Yep, got it. I want to give you a quick caveat about hiring a realtor. Out there in most states, you're going to find that there are two types of buyer agency agreements. You definitely want the realtor you're working with to be your agent. The default position is that they're the seller's agent. You want them to be your buyer's agent. So you have to sign something to hire them to be your buyer's agent. But they're typically two forms. There's an exclusive buyer's agency agreement that says you have to work with that agent. And there's a non-exclusive buyer's agency agreement that says, if we don't get along and you don't like me, you got to work with me on the houses I showed you, but you can fire me and go hire another agent. Just be real sure that you sign a non-exclusive agreement, not an exclusive agreement, because you don't know that agent well enough yet to sign an exclusive agency agreement. All right, let's talk about making an offer. Once you find the property that you want to purchase, you're going to need to have some things in your arsenal to help you because there's a lot of competition out there. The first thing I would say to you about today's market is when you go talk to that lender early on, go ahead and get pre-approved, not just pre-qualified. Pre-qualified means you sat down and had a conversation with them. You told them about your finances. They ran all the numbers and said, well, here's what I think you're qualified for. That's being pre-qualified. Pre-approved means they've pulled your credit. They've verified your employment. They've looked at all those things. They've already underwritten you. And so all they have to do is underwrite the property. If you make an offer and can give them a letter with that offer saying that you're pre-approved, that's stronger than anybody that's just qualified. Secondly, have your money ready. If you've got a down payment and closing costs, that has to be in your bank account. If you're in a family situation where someone's going to gift you some money for that, that's fine, but most lenders require that it be seasoned. It has to be in your bank account for a certain period of time, maybe 3 months. And so you need to talk about where that money's coming from early on and have that plan. And then again, I've said it several times already, be ready and willing to move fast and act fast because we're in a seller's market where there's a lot less property for sale than there is demand. And there's going to be competition on any property that you go after in almost every market that I'm aware of. That leads me to say, in this very competitive market, don't dilly-dally around. Make your best offer when you make your first offer, because you should make the assumption you're going to be in competition. Now, in North Carolina and most states, we use what's called a due diligence form of contract. And in this type of transaction, a buyer pays the seller a non-refundable fee for having the home tied up. I want to take 1 minute to go through what these terms due diligence fee and earnest money mean. And you can look at the contract that I'm going to send you as a sample. And what you'll see if you look on the screen today is there's a place for the purchase price, there's a place for a due diligence fee, and there's a place for earnest money. And there's some definitions which we'll get into in the notes and if we have time at the end, but we're in a crazy market. Due diligence money is the money you pay that in concept makes the seller whole for the fact that he's taken the property off the market while you do your investigations and due diligence. That money's non-refundable from the get-go. Prior to the craziness we're in now, that was $1,000, $1,500, $500, $2,000, a small amount of money. Earnest money is typically a bigger amount of money, and that goes in escrow, but it is refundable up until the end of the due diligence period. Well, what we're seeing out there today is lots of buyers are putting down really big due diligence fees to make their offer more attractive to the seller, because if the deal doesn't go forward, that due diligence fee is lost. But you need to be careful. You need to understand due diligence fees are non-refundable from the get-go. Earnest money doesn't become at risk until you finished your due diligence and say, yes, we're going forward with the deal. All right, real quickly, the offer and contract process is where your agent and you would draft a written offer. Everything in real estate has to be in writing, and it's presented to the seller. When the seller receives an offer, they can do three things. They can accept it, saying, fine, I'll sell my house on those terms, sign it as it is. They can reject it and say, what a ridiculous offer. I don't even want to deal with this person. It's like tearing it up. More likely, they'll make a counter offer. Say, well, I'm glad you're interested in my property. I can't sell it on exactly those terms, but here are the terms I would sell it on. That's called a counter offer, and it's actually an offer back from the seller to the buyer. And when the buyer gets it, the buyer has the same three options. They can accept it and say, that's great, let's do it, we got a deal. They could reject it, or they can make more counter offers. At some point in time, though, there's going to be an acceptance. When there's an offer and an acceptance, boom, that's when there's a contract. At law, we call it a meeting of the minds. And that written document, that written contract is going to control everything that happens in the transaction. Okay, we've talked about contract negotiations. Now we're at due diligence, where we're going to do all of our inspections. We're going to use a professional inspector, because we're not that. If the roof looks old, maybe a separate roof inspection or a separate HVAC inspection. Those are important things, and you want to do your due diligence. While that's going on, the bank's going to be ordering the appraisal. And at the end of due diligence, it's typical that the buyer would prepare a repair request list and submit it to the seller saying, I want you to fix these things that are deficient. In this crazy market we're in now, we're seeing lots of people waive that and say, I'm not going to ask you to make any repairs, or the sellers are just being tough and saying, I'm not going to make any repairs, because it is a seller's market. But you need to know what the issues are that you're going to have to face if you do buy that property. During due diligence, you have the right to terminate the contract for any reason or for no reason. So it's sort of like playing chicken. The seller doesn't have to do repairs, but you don't have to buy. Normally, there's leverage on both sides. In today's world, it seems like sellers have all the leverage. What I've found in negotiating is sellers tend to be willing to talk about things that have to do with structural integrity, safety, or the function of a major system, such as heating, cooling, and electrical. Be careful in the inspection process. There's some notes you'll be able to look at on that, okay? The repairs, if there are any, should be done before closing so they can be re-inspected. And at the end of due diligence, that's when the decision is on the buyer to say we're going forward or we're not going forward. If we go forward, the next step is called closing or settlement. And that, in its simplest sense, is where the buyer brings the money and the seller brings the keys. And there's more to it than that. There's paperwork for both to sign. Usually it takes place in an attorney's office. And the thing to remember is the deal is not done when you leave the lawyer's office from closing. The deed is not done until the deed is recorded at the courthouse. So plan your closings for in the morning so the attorney can get it recorded at midday or during the early afternoon, and you can get the keys that afternoon. Don't trap yourself into a 3 or 4 o'clock closing, and then it may not get recorded until the next day. I've got coming up after this some specifics about closing. It's really just a checklist for you of things to know. I'm not going to go over that with you today because it's all written out in detail, and you'll be able to just work down that checklist and look at it. We're also getting really tight on our time, so I'm going to stop, Gene, at this point, and let's see if we can answer questions.
Okay, if you want to enter your questions in the chat, or if you want to speak up with any questions, I know we are getting really close to that 2 o'clock time here on the East Coast. I don't know, I think we have folks across the country, but is there anything that Norman did not discuss that you would like to answer in these next few minutes? I would also like to mention that on September 8th, from 7 to 9 p.m. Eastern time, we will be discussing investment properties. So I know some of you had some questions about that in your original registration, but we will be going into those types of details on the September 8th presentation. So feel free to enter any questions you might have in the chat or speak up.
And remember that you're going to get a transcript with all of this written out. And I would suggest you hold on to that for your transaction. Use it as a checklist for yourself.
Norman, are you seeing the chat?
Yeah. Question is, how long will my pre-approval last? And that's going to vary a little bit from lender to lender. Typically 90 days would be a starting point. Although I've got a transaction closing on Thursday that's been drug on for months, and State Employees Credit Union has been kind enough to extend and extend and extend and to hold the rate. It's going to differ from lender to lender. That's a question as you shop for a mortgage lender, is to ask them, once I get a commitment and lock in a rate, how long is that lock-in good for? And you want to sync that with your contract so that you close within the time that your rate is locked in. But 90 days would be a standard.
First-time homebuyer program. Some states will let you buy a second home with first-time homebuyer programs, depending on how long it's been since the first purchase. Do you know any details about that?
I'm sorry, I don't know any details about that. And I would think that would be very much vary from lender to lender.
And with the rates dropping, and as often as they did last year, how many would be too many refinance inquiries?
I'm not sure what they're asking there, Gene, but if they're thinking that every time you apply for a loan, it lowers your credit score a little bit, that's true, but I don't think you're going to refinance that quickly in time that it'll be a problem if that's what they're asking about.
What issues do retirees face or need to consider for buying a home after selling their principal residence?
Qualifying for a mortgage if they're going to get a loan. They may be retired and not have income. So if they're going to get a mortgage, that all needs to be discussed and worked out way up front. Most people that are selling a home today have a lot of equity, and so that doesn't become a problem. But that would be the first thing I would say to retiree. And second thing is you might consider buying something that later on, if your situation changes and you need to go into a care facility of some kind, might be a rental that you could keep. In fact, I'd say that to anybody. Buy something that you like and that meets your needs, but that in the future might become a piece of investment property for yourself, a rental property. A lot of people get their first rental property as the home they live in now.
Looks like we've got a couple of HOA questions on here. I will note that it is 2:00. I know some of you may need to jump off the call. And I don't think we would be able to provide a list of recommended lenders because we're not really using this platform as a place to give recommendations for specifics like that, but more for general information to help you have the tools you need when you do go forward and look for lenders and agents.
I would just say shop lenders, talk to more than one. This is the biggest debt you're probably ever going to incur. So it's worth taking a little time to shop. Talk to a bank where you have a relationship, and then talk to a mortgage broker that can shop across a number of lenders.
All right, the HOA questions. Any opinion on monthly HOAs for multifamily versus no HOA for single family? HOAs seem to be beyond one's control and can take away some purchasing power. And the second question was, how does one get HOA documents before closing so that you know the financial situation in a given community?
Let me start with the last part of that first. Almost every homeowners association is managed by a management company. There are some small communities where they self-manage, but that's very rare. If you are working with a realtor, they'll be able to tell you who the property HOA manager is, or get you the website address. In my market, you can go online to any one of those communities, have a web page, and you can download the documents from there. But your realtor, if necessary, can get them from the current owner of the property. And yes, you do want to look at and understand the homeowners association requirements. Now, it's not really true that single family homes don't have HOAs. Most of them today do. There's some that don't. But they're good in a way that they can protect the neighborhood from someone not taking care of their property. But there are costs associated. When it's a single family neighborhood, it's going to be a smaller amount because they're not doing anything to maintain the buildings. It's typically just the common areas, the grounds, if there's a swimming pool or tennis. When you get into townhomes and condominiums, multifamily, then it typically is also taking care of some of the structure, like I mentioned, the roof, and more likely to have recreational facilities. So those tend to be higher. But you're right, it's part of keeping the cost, it's part of that cost of keeping the roof over your head. And the higher those dues are, the less can go for principal, interest, taxes, and insurance.
I've got, it looks like 3 more questions here, and we will need to cut it off. First one is, how far in advance do you recommend people start this process before their target move date? Will you still run into bidding wars if purchasing new construction? And then the third one is seller financing. Is it more tax advantageous for a seller than outright sale of their residence, which incurs capital gains? I think that sounds like a long answer.
Okay. Well, would you repeat the first one again, Jean?
How far in advance do you recommend people start this process before their target move date?
Well, I don't think you have to work through the whole process in advance, but the first thing I would do is determine the area that I want to be in. If you're staying in the same locale where you are now, it's still what part of town do you want to be in? I would try to decide, what area do I want to be in, and then find a real estate professional to assist me. And just like with lenders, I would talk to 2 or 3. This is a huge transaction and a huge amount of money. Don't just pick a realtor that's somebody's cousin's sister. Interview them, find out what their experience is. Is this somebody that's going to work with you personally and give you time? I would do that early on. I would talk with a lender early on. And when I say early on, I mean like 6 months in advance, because you need to have those relationships established so that as you get closer to the time where you're going to pull the trigger on the home search, you want to get started. And if I want to move in, let's say in December, I need to start looking in September, because once I go to contract, it's going to take 30 to 45 days to do the due diligence, to get the loan underwritten. So at a very minimum, you need to start about 4 months in advance. What was the next question, Jean?
Are you still seeing bidding wars if purchasing new construction?
We are seeing that, but we're also seeing builders not being willing to put a price on anything until they have the construction almost complete. That's because their prices have been changing so rapidly on building materials. Now, in new construction, most builders are taking a waiting list for a community. And if you're interested in a specific community or 2 or 3 communities, it would be smart to go ahead and get your name on the waiting list so that when a property does come available, I think most builders are going and working down those waiting lists saying, all right, Mr. Jones, we have this model. It's going to be available on this day. Do you want it? If they don't want it, they'll go to the 2nd, the 3rd, and the 4th. So with new construction, I think it's important to get on a waiting list at 1 or more communities that you're interested in. You're going to see that more than bidding wars.
Before we go to this last question, I do want to thank everyone for attending. Those of you who have attended all 3 sessions, you will be getting an email from me in the next few days regarding your member prize of the lunch bag or the wine tote. Everyone will be receiving an email by Friday afternoon with this recording, as well as the documents that Norman mentioned earlier. Thank you for being here. And then the last question was, can seller financing be more tax advantageous for a seller than outright sale of their residence, which incurs capital gains?
Okay. Well, the first thing I'd say is the outright sale of their personal residence doesn't involve capital gains if it's a married couple, unless you have more than $500,000 in gain. So be really sure that you know what situation we're talking about. For most people, when they sell their personal residence, they don't have more than $500,000 in gain. So there is no tax. So in that situation, I think you'd be smarter to sell and get your money. If you're selling an investment property where there would be capital gains, there is a strategy that says it's smarter to owner finance, because then it can be treated, your tax professional can treat it as an installment sale, and you don't pay those taxes all at one time. But in the personal residence situation, unless you're dealing with very expensive properties, I doubt that you have more than $500,000 in gain. There typically isn't capital gains on the sale of a personal residence unless we're way, way up in the price ranges.
Okay. I think that covers the questions that I have seen come through. Again, I want to thank Norman for this very valuable presentation and for all of the information that he is sharing. And if you want more information about investment properties, join us on September 8th from 7 to 9 p.m. Eastern Time. Otherwise, have a great afternoon. It's first day of class here in Chapel Hill. In case you did not know, our students started class today. And fingers crossed for a great semester for all of these students here in Chapel Hill. Thank you, Norman. Thank you, everyone on this call, and we'll see you soon. Go Heels.
Thank you. Go Heels.
Thank you.